All right, ladies and gentlemen, I hope you had a wonderful day. It was an absolutely wild start to this week because after all of the drama that we've had over the last 48 hours, Biden dropping out, and everybody expecting so much, the reaction that we got this morning was very weird. It was very small, and it is begging the question that the volatility still remains, and it is being suppressed right around the corner. So we got a lot to talk about, but what I'm going to start here is with a pretty hot take, and the number one question of the day everybody was asking, were the politics priced in? Why? Because we woke up to Joe Biden dropping out of the race, and although that was over the weekend and we had time to trade the futures and all of that, you had very minimal price action related to this trade, and it was kind of weird because in the few weeks ahead of it, any anti-Trump or for Trump trades for or against Biden, they would cause a lot of volatility, and today, after Biden dropped out, none of those trades got any sort of bid. Volatility was muted, and quite frankly, we have no idea what is actually going on with Joe Biden. So this is the second part of where I'm saying maybe we didn't get a reaction here because something is still lurking. And let me show you what I'm talking about here, because one, you did not hear from Joe Biden today. He did sign an executive order. Kamala did go up, but it was this own little thing, and she talked about these other stuff, but it was just in her normal capacity as vice president, and technically she does not become the pick until they have the DNC in a few months. But I'm trying to tell you here, I don't think the public is fully digesting the scope of what just went down. And the last time we had anything like this similar happen, it was the 50s and 60s. You had Harry Truman and Lyndon B. Johnson. They were the last candidates that stepped down. But now this is where it gets interesting because they all had pretty big announcements. So let me just show you this. This right here is Lyndon B. Johnson.
And I will not accept the nomination of my party for another term as your president.
So that's him, and then take a look. Here's Truman.
Nominate for president this year. He will have this record to run upon. I shall not be a candidate for re-election. I have served my country long, and I think efficiently and honestly. I shall not accept a renomination. I do not feel that it is my duty to spend another 4 years in the White House.
See, they were really sad. But hopefully you guys see my point that I'm saying here, where it's like, yo, this happened over the weekend. We haven't heard from Biden. We haven't heard from anybody really, and even both of those candidates back then, they had a lot of stuff going on. Like LBJ, he did deal with a heart attack, but he was relatively young. He was only 59 years old, but he was unpopular due to the Vietnam War. Truman, he also had the Korean War and the McCarthyist and all of that stuff that got in his way. But why I'm bringing this up, I hate to show you a Twitter, but the fact of the matter is, in this last 24 hours, you have a sudden resignation by Joe Biden. His staff isn't even aware of it. Last weekend, he's like, no, I'm not dropping out. I'm not doing unless I get hit by a bus or train and get COVID at the same time. I'm not leaving. And then apparently it doesn't have an official letterhead. It's a weird signature on it. And the whole point is we had all of this over the weekend. Today, we wake up to no market reaction. You don't hear from Biden, and you don't watch any official thing. Again, Lyndon B. Johnson, Harry Truman, when any of this stuff happened, it was a big deal. They all went out. You don't really, this is like getting broken up with over text by the president. That is very odd. So what am I trying to say? Something is still lurking behind the corner. I don't think the market is fully digest this. And when you're looking at today and trying to figure out, wait, why did this move? Why did this not move? I think it's a mix of summer and earnings, but clearly there is more to this story, and once we get the full picture, then I think we're going to get a bigger move, especially as we get ready into the election. So Chad, you let me know what you think. I already created a lot of friends and enemies today with today's live stream, so we'll find out. But the point is, this is going to come up a lot. Day one of this was already kind of weird, and I am pretty certain that we have a lot more volatility lurking around the corner. So Chad, let's talk about all of it. I got got another recap of the day, what we need to look at tomorrow, the plays I made, what we're going after tomorrow, and then I think that's pretty much it. What I need from you, a thumbs up on the video. Make sure you're subscribed, and if you don't know, we are live Monday through Friday, 30 minutes before open, youtube.com/the stock market. We will see you there in the morning, baby. Run it.
Walking to the couch, it's the joints on the legs. Live in the hills, but I still get a spread. Started with a live, but I still reinvest it. Feel how I feel, then you feel less a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but they sound like progression. Farmer never plans if he waits for perfection. Finger to the down, hold it.
But right off the bat, like I already told you, it was a really weird day. None of the Trump trades or anti-Trump trades really worked out despite how pivotal of an event we got. And even though it was so pivotal, you had really no press coverage or event announced by the president, which goes very different from any time we've seen it in history. And then the fact that we have earnings right around the corner in the market and a lot more data, I only think today is going to get weirder. So this is the first thing you got to watch out for. We saw it a little bit today, and it is that rotation or the reversal of that rotation you were seeing last week. And essentially today we woke up, Nvidia was up, the NASDAQ was killing it. None of the Trump trades really responded. And if you notice, the Russell and Dow Jones were down in the morning while the NASDAQ was up. That is the exact opposite of this last week or two that we've been getting with the rotation. It really wasn't until the end of the day. The SPY also bounced back up. NASDAQ also got up too. And then the Russell was able to come up a little bit. And that's what kind of saved it. But this is what I'd be paying attention for. Do we watch how the market takes this data, anything from Biden or that volatility, whatever happens, and just pay attention of whether or not the small caps, the beaten down names, and this rotation continues to outperform all of the mega cap tech. We saw it for a little bit. I thought it was going to be a lasting theme and then kind of fell back into 50-50. So today, although there was a lot of confusion and a lot of movement, the fact that the Russell kind of ended back up with everything, it didn't really give us that many answers. So keep your eyes out for that as we get these next set of datas and how the market moves. I really think that'll be a big determinant of where we're going to be ending this week on whether or not we are being led by mega cap or if we're still playing this rotation game. But watch out for that. That is the first key. The second key is coming into tomorrow, and we actually have a lot of data. You're going to be getting PMIs, both services and manufacturing, I believe. You'll even get PMIs from overseas. Then we're going to get our new home sales data, and that could give us a little bit of wiggle room to see what's really going on. The fact that we're dealing with the politics, muted reaction, this rotation back and forth. Let's see what the data provides, and you will need something to snap, though, if you want a really big or easy read. If we see PMIs get blown out in either direction, if real estate gives us a big move, that could give us the jump start to actually be moving, and then we can get an idea leading into the final data and even Powell. But if everything kind of comes in line like we've been seeing the last couple weeks, then once again, you're going to get the data, maybe get a little bit of a bond dollar action, and then back to the slow summer session. And then here's the best part about it. Although I do think we have a lot of data points to react to tomorrow, by tomorrow morning, you're going to have data on the consumer, Spotify, UPS, Coca-Cola. You had NXPI, Cadence Systems, NXPI after hours today. This is one of the biggest week for earnings, and we have those companies hitting. And now with consumer names reporting tomorrow, by the time you wake up, you're going to find out how they're doing and whether or not it supports or hurts any of the recent themes that we have been getting. So watch out for that. I think that's going to be huge. And then finally, we talked about the bonds a little today. Everybody was keeping their eyes out for the Trump trade, and I thought it was very interesting. And if you didn't notice, we've killed it on the bonds the last couple of weeks. We've had good bottom ticks, sold out just a couple days ago, and it came right back down. Again, to take our profits on it, it's been a fun time, but I'm here to show you something, and this is where I want you to learn. It's one thing about the play, and maybe the plays aren't happening just yet, but if you do watch this, maybe this could give you something to focus on, and then you'll be prepared for the next move. But go look at the 10-year, and you will notice we've been doing the dance from 4.5 to 4.25. So it really started even at the end of May. You got right above 4.5. then you shot down to 425, then you shot back up to 445, then you shot back below 425, chilled there for a week, then shot back up to 449, shot back down to below 425, and then sure enough, we're chilling at 425. Even if you go back throughout the year, this 425 is an interesting level. Even in 2022, who would have thunk it? That was your, I remember the low, October 20, remember everybody Meta and all that? Yeah, well, rates are pretty much the same thing about 2 years later almost, but this is why I'm trying to show you guys, because it's like, dude, these plays aren't magic. If you haven't noticed, we're just playing that range, and how this moves, that's telling you something. The 10-year at 4.25 or 4.5, that's insinuating an amount of cuts and where people think things are going to be. And as of late, this range is what I'd keep watching. Watch for this to either hold, and it'll keep dancing 4.5. If every time it hits 4.5, it'll come back down to 4.25, and then if it undershoots 4.25, it'll bounce back up to 4.25, then maybe back to 4. If it could hold below 4.25, it'll touch 4, then probably bounce back up to 4.25, and you're going to get that until something meaningful changes, whether it's data, the economy, Biden, who knows. As that stuff starts to move, then that's going to start opening us to get out of this range. But until then, you may move within that quarter point, and that could be good to trade, but it's also going to just kill a lot of premium. And again, going back to that 10-year chart, remember when we talk about the duration risk, I'm showing you this level and how important it is, but like, think about it. 2 years later, you're pretty much at the same yield. That's duration risk right there. Imagine you were betting higher or lower. 2 years later, has not done anything. So we'll see how that plays out, but I thought that was a good thing to show you, and I do think as things come out here, this will be something we'll probably notice as we go either below 4.25 or we get a little bit more volatility and get back up there and see where rate cuts data and everything else is. But now, let us get into the play. So, right off the bat, I hope you guys are getting it. I think we got to keep an eye out for some of the politics and where it plays forward. Keep your eyes out for earnings and data. Otherwise, it'll start moving slow. And don't forget about the bonds. But now, as far as the plays, I got 2 earnings, one related to the politics here. The first one is Tesla. I did make a play on this. I think I grabbed the 195 puts for next week. Yeah, those are the ones, the August 2nd. I grabbed 50 of them at about 56 cents, so I already got a nice gain, and my idea is to sell out more than half of those tomorrow to make that play free. But why did I go with that play? Because the stock was up 5% today. Their earnings are tomorrow, and the way I'm looking at it, there's either going to be time to replicate this trade tomorrow, or it's going to be an absolute dud, aka tomorrow the stock is either going to gap down after having a huge gap up, and then we win, or it's going to keep going up, and then that earnings continuation is going to keep going. So this is a bigger play. It's on Tesla, and I'm going for the pre-earnings play on Tesla, and I do not plan to hold it for their earnings, sell out right before, take all the money, maybe hold one for free if we can, but ideally I do want to close all of them. And the interesting part, it does have to do with Tesla's earnings, but remember, they just had delivery numbers. So in a weird way, the expectations are all over the place with Tesla, and they have recently just had a monster move. So we'll see where that leads us. But that is the first play. Watch out for that. That's number 1. Then play number 2. I got 2 different sets, but I only made a play today on Philip Morris. I believe I grabbed the next week, August 2nd, 115 calls. I grabbed 2 of them for 23 cents a pop, and this is going to be my other earnings play. They report tomorrow morning. Philip Morris, MO, doesn't report till later. They will be a sympathy, and I went a little bit outside of 2 standard deviations. I didn't really like this play too much, but I like the trend and I like the company. This whole idea of Zyn, the Zindemic, and the smokeless trend, it is booming all across America. I think all of these smokeless companies and cigarette companies that offer it, especially Philip Morris and Zyn, they're the ones that are benefiting the most off of it. So I said, hey, I'm going to go with the $50 play. If they do report good, I think they'll benefit the most, and then we could go for the MOs and all of that, and then we'll just see. If it doesn't play, then that'll be unfortunate. I mean, my unfortunate reality is that maybe I'm wrong on how this trade plays out, but I do think that for the long-term tailwind, this Zyn stuff and smokeless is going to be a huge driver for all of these stocks. So watch out for that. That is play number 2. And then finally, We talked about gold, the dollar, healthcare, crypto, all of these Trump trades yesterday, and we brought up energy in passing, but this was a trade idea I couldn't shake my mind off of. I was glad it was down today, but I got really greeny, and I'm kind of glad because it was still down, but oil. And I really like this trade, but I did not do it. It was hard to make a trade on it. Oil's been all over the place, and then it started selling, and then it was into the lows, and then it would bounce 0.5%, but then still be down. So it was difficult, but I do think the whole Trump trade is kind of lagging here a little bit. I do think eventually the roosters or the chickens will come home to roost, but I do like oil. I just need it at the right price. So I'm down to make a flip on this one tomorrow. I'm going to keep my eyes out for it. Ideally, I think $76.50 to $76 on crude oil. That's like the money zone where things could get good. Otherwise, we're going to have to kind of wait and then maybe wait till there's actually a good news driver to FOMO in. Otherwise, wait till it hits that low, buy out, and then swing that until you actually get one of these election volatility pops and then go from there. And like we were talking about with bonds, eventually too, if oil does get cheap enough, don't forget this is one of the cheapest geopolitical risks out there, especially the lower and lower this goes. So watch out for that. We're going to be seeing where that goes tomorrow. And then I think that's it, and I think I didn't make any other plays. I have the lesson for you. We are going to go over multinational corporations, but yeah, I believe that's all I have. Yeah, I only made the Tesla and Philip Morris plays. I'm still in the gold play, and then we'll see where anything else takes us. I still got the snap and all of that other stuff from last week, so we'll just be riding it out. But now, getting into the MNCs and advanced industrialized economies. Remember yesterday we were talking about how these MNCs balance the politics of the developed nations and how these developed nations try to take in the FDI but not give up too much control, but kind of a lot of the developed nations don't want to reject it. And then nowadays we've just blossomed into this global world where everybody is just relying on FDI, and usually there's a higher cost rejecting it than not, but that was related to the developing countries. So now it's a very quick one here today on advanced industrialized countries. So beginning, the typical advanced industrialized country has been more open to FDI and less inclined to regulate activities of MNCs than the typical developing country. Only Japan and France require explicit government approval for manufacturing investments by foreign firms. Most governments have excluded foreign firms from owning industries deemed critical, but they have not drawn the list of sectors from which foreign firms are excluded so broadly as to discourage MNC investment. In the United States, for example, foreign firms cannot own radio and television broadcasting stations, cannot own domestic airlines, and are prohibited from participating in defense-related industries, nor are American restrictions unique, as most industrialized countries prohibit foreign ownership in many of these same sectors. Japan was the clearest exception to this tendency throughout much of the post-war period. Until 1970, Japan tightly regulated inward FDI. Japanese government ministries reviewed each proposed foreign investment and approved very few. Proposals that were approved usually limited foreign ownership to less than 50% of the local subsidiary. Such restrictions were motivated by the Japanese government's economic development objectives. Government officials feared that Japanese firms would be unable to compete with MNCs if FDI was fully liberalized. In particular, the Japanese government feared that unrestricted FDI would prevent the development of domestic industries capable of producing the technologies deemed critical to the country's economic success. Regulation on inward investment thus comprised an important component of Japan's industrial policy. Japanese restrictions on inward direct investment were designed to encourage technology transfers. Japanese officials first pressured foreign firms to license their tech to Japanese firms. If this strategy proved unsuccessful, the Japanese government would consider a direct investment, but it often attempted to force the foreign tech firm to create a joint venture with a Japanese firm in order to transfer tech to Japanese firms working in the same industry. Only if a firm was unwilling to license tech or to form a joint venture, and then only if that firm controlling the tech were not available elsewhere, did the Japanese government permit the creation of a wholly owned foreign subsidiary in Japan, and even then the government often attached conditions to the investment. IBM, for example, was forced to license critical technologies to 7 Japanese competitors in exchange for being allowed to produce computers in Japan. Japanese investment restrictions have greatly been liberalized since the late 60s. In 1967, Japan increased the number of industries open to foreign investments and began to allow 100% ownership in some sectors. Additional measures taken in the 70s and early 80s further liberalized inward FDI, so that Japan now has no formal barriers to such investments. In spite of this liberalization, however, Japan continues to attract only a small share of the world's foreign direct investment. Despite the general tendency towards greater openness, governments in advanced industrialized countries have been sensitive to foreign control of critical sectors. Two instances illustrating such concerns: the China National Offshore Oil Corporation, CNOOC, sought to purchase Unocal in the summer of 2005. In early 06, the United Arab Emirates owned Dubai Ports World sought to acquire a British firm that operated American seaports. Both transactions prompted strenuous congressional opposition, and this opposition led both firms to withdraw their offers. Lenovo's acquisition of IBM personal computer wasn't closely scrutinized, but ultimately was approved in 05. These recent cases indicate that American policymakers remain highly sensitive to foreign ownership of critical industries. In summary, even though advanced industrialized countries have been more open to FDI than developing countries, they have attempted to manage the terms under which MNCs invest in their countries. Governments that used industrial policies have attempted to protect national firms from competition by restricting foreign investment. Even governments that refrained from promoting active industrial policy restricted foreign ownership of sensitive industries, such as those at the forefront of high tech, as well as industries closely connected to national security. So it does keep going on, but sadly, I think I'm going to end it here because it goes on with the bargaining and it gets a lot longer. But here's what you got to realize: different policy with MNCs and how you handle the politics between both. But I mean, you should notice, what do you notice from all of this? There is a common theme, whether domestic or, advanced industrialized nations, they're supposed to be more welcoming of foreign direct investment, and they are, but just like the other countries, they are always trying to keep control, and there is a limit or a red line to what they're willing to let these corporations do, and that's where the governments come into play. But hopefully you're noticing this relationship between governments and the corporation and trying to both attract the money and not give up too much of your rights as a country. That is the dynamic here, and even if you are advanced and bringing in all the money, you still are going to face this, and then vice versa. Even in the development stage, you are going to have limitations, even if countries are really trying to get your money out there. So now, hopefully that makes sense, because we're going to talk about bargaining with the multinational corporations and how they find their answers and what makes sense for everybody. But Chattadonia, that is your watch list, ladies and gentlemen. Make sure you're healthy, ready to go. Make sure post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. And I need you to remember, be weighted in what you're doing. One direction. Know where you want to go. Know where you want to end up and follow that. Separate the good from the bad at the end, and you will be good to go, baby. So Chattadonia, stay in the game. Drink that water. Stay hydrated, healthy, all that good stuff. I'll see you in the AM and on.